Hi, welcome to this week's live stream with Gotham Sound and Communications. I'm Nick Houston. Today I am here with Nancy Adams, CPA, and Ann Johnson, financial consultant and former production accountant, retired. And today we're talking about everybody's favorite subject, taxes. And Ann has been nice enough to prepare something, a presentation.
Nancy, that's Nancy.
I know we look alike.
Right, sorry. Nancy has been nice enough to prepare a presentation for us about, some tips and tricks new for 2016 and just general stuff about taxes. So I will let Nancy take it away.
Thank you. Very happy to come out to Queens on a nice rainy day. I always find that it does so much for my hair. I have done a similar presentation, so I just kind of modified it a little bit to talk about things that are very specific to people in the production industry. Ann and I argued over who was going to get to go. We tossed a coin and I won. So here we go, without further ado. A little bit about me. The objectives of what I want to talk about today are talking about deductions, what are sort of some of the basic rules behind deducting things, rules about specific types of expenses, recent tax law changes, some update of health insurance. For the most part, I think that most people have heard about this and know a lot about it, but just a couple of comments. Things to make sure you do when you're preparing your 2015 taxes, and things to think about going into 2016. So the reason that you're allowed to deduct expenses in general is that Section 162 of the Internal Revenue Code says that people engaged in a trade or business are allowed to deduct expenses that are ordinary and necessary. So a trade or business is defined in the code as being an activity carried on for profit or your livelihood. Ordinary and necessary, now that's a little more interesting because there is no specific definition of that. It's a facts and circumstances kind of test, and it's based on what is common and ordinary to your profession in particular. So, it really does vary by profession and by person. Where and when do I deduct things? Well, it depends in part on whether you're self-employed or whether you're a W-2 employee, or a little bit of both, as is fairly common in the production industry. If you're a self-employed person, strictly self-employed, you normally deduct all of your expenses on Schedule C. If you net it against your revenue from production or from services, and then you calculate your taxes based on the net of that. If you're an employee, you deduct it in an entirely different place. You deduct it as a miscellaneous business deduction, which is an itemized deduction on Form 2106, where you have to meet a certain threshold to be able to deduct that. So there's first a 2% threshold deduction, meaning 2% of your adjusted gross income in being able to get to deductions. Now, what does that mean? So, for example, if you made $100,000, you're doing well here at Gotham Sound.
Yes, if only.
Yeah. So $100,000. What that threshold means is that as soon as your expenses exceed $2,000, you can start to deduct on that line. Mm-hmm. So, for example, if you had $3,000 of miscellaneous deductions or employee-related business expenses, you would get a $1,000 deduction. Mm-hmm. Now, your ability to take that depends on whether you can itemize or whether the standard deduction is higher for you. So deducting it on Schedule C in some respects is a bit easier because it nets directly against your self-employment income. Mm-hmm. On the other hand, you're going to owe self-employment tax on it. Mm. What if you're self-employed and a W-2 employee? Then you need to make some reasonable allocation between the two to say, if, for example, half your income comes from self-employment and half comes from wages, then, it would seem reasonable to allocate your expenses half and half. Or you can make some other allocation if the facts and circumstances warrant it. So, for example, if I specifically bought a computer to facilitate editing because I do editing as a side gig, then I could deduct that directly on Schedule C. But you need to think a little bit about it and make some reasonable allocation on your expenses.
Now, for me, so, obviously, we're talking about, like, if I was doing things at Gotham Sound, like, what else could be included in that besides a computer? Like, are my shoes included? Do I get my hair done? Maybe lunches?
Oh, those are really good questions. We'll get into that
Okay.
a little bit more specifically further down, and we'll come back to that. I don't know that I specifically addressed shoes, but I did discuss work clothing, so we'll come back to that one.
Perfect.
When do I deduct things? Individuals are cash basis taxpayers, meaning you deduct it when you pay it. The one exception to that rule is credit cards. If you put it on a card, it's considered deductible when you charge it to the card, not necessarily when you pay the card. What kind of documentation do I need to keep? Keep it all, I say. Technically, the IRS says for travel and entertainment expenses that are below $75, there's a de minimis threshold that you don't really need to keep that. On the other hand, an agent could just arbitrarily say, well, I don't feel good about your deductions, and since you don't have receipts, I'm not going to allow those deductions. So even though it's not required, it's recommended. There are higher substantiation requirements for certain types of expenses that the IRS considers susceptible to abuse. For example, travel and entertainment, gifts, and what is called listed property. Now, listed property is really interesting. I took a look, because Ann and I were talking about this not too long ago. I took a look at the definition on the IRS website. And the most common example is they consider it susceptible to abuse, so they want you to track that. So the most common example is autos. And autos, you're supposed to list the business usage there and say how much of the auto did you use. Now, technically, it also said communications equipment, photographic, and so on. As a practical matter, for most of my production personnel, I don't keep track of phonographic, that sort of thing, separately as listed property, because truly it is used in the trader business. Mm-hmm. As a telephone, we were specifically talking about the question of telephone. Well, in fact, most phones are sort of fall below the threshold for having to capitalize them. So for the most part, you're really not going to have to track the cost of the phone itself. Now, telephone usage, we'll come back to that. It's a good idea to keep contemporaneous logs, so meaning that you track your information as you go along, because the IRS doesn't find it very compelling when you recreate it after the fact.
Uh-huh. So we're talking about mileage and things like that?
Yeah.
Mileage, yeah. And
don't write in your diary. People who still keep diaries don't write it with the same pen.
Yes,
Use different
yes.
colored inks.
That's it. I used to know an accountant who would keep calendars that he would mail out, and then years later he would happen to have them if someone were audited.
Well, and so do the stationery stores.
Yes.
Stationery stores have backdated diaries all the time.
That's very funny, but we don't recommend that. What we recommend is a contemporaneous log.
Right.
And I'll tell you, it is actually pretty reasonable. I've had on a different matter, I've had a number of cases where people have been audited about days in and out of New York, where they live in Connecticut, for example, and the state auditors can be so tough on that issue of proving, where you were and when you were. So it's a good idea to really track that information. So now I wanted to talk a little bit about specific expenses, including, we're going to start with meals and entertainment. And the code says basically that you have to meet one of two standards to be able to deduct a meals and entertainment expense. One is that it's directly related to the active conduct of trader business. In other words, you are meeting a person with a specific expectation that you're going to pitch them for business, you're going to try to do something to generate business. Mm-hmm. And then the second standard is that it's entertainment that's associated with the conduct of trader business. So in other words, you've had a client in from out of town, you've spent the day going through records and so on, and at the end of the day you decide to go out to dinner together and see a show that night. So that would be indirectly associated with. Mm-hmm.
Can I throw in something
yeah,
here?
absolutely.
If you are in a visual business and you take somebody to a Broadway show, entertainment is only 50% deductible, but if you are taking yourself there and you're in that field, you can count your full ticket as research.
Uh-huh. Okay,
That's it.
so half of it, so
I mean,
their ticket would
their
be
ticket would be
50%.
50%.
My
Yes.
ticket would be 100%.
Right.
Got it.
If you're in that field.
Right.
Yes,
Yeah.
yes, if you're in that field.
Yeah.
Telephone. Now, this is a standard that's changed a bit over time. Originally, everyone had a home line.
Right.
Now, a lot of people don't have home lines. They only have a cell phone, and that's the only phone that they use. The basic rule is the basic cost of the first phone is non-deductible. So if you do have a home line, the IRS said, oh, hey, you would have a home line anyway, even if you're working from home. They did say, however, that you could deduct long distance if you had specific long distance. For the cell phone, you've got to make a reasonable allocation between business and personal usage. And I'll tell you that is the first question that I am asked in audits is, how much did you claim on cell phones? And it's, generally it's not even that significant of an expense, but it's one of those ones where they want to know, did you allocate something towards personal usage? So if we can say that, it's like generally the audit goes a little bit smoother.
Well, I always ask if you have a home phone also, because if you don't, if your cell phone is your primary phone, I usually eliminate at $30 a month right off the bat. And then we go the percentage of the balance of it that you use for business, because it's like it's your first line.
Right,
Yep.
so it's like what the line charge would be just to turn it on.
Right, just to
and
turn
then
it on, right.
allocate it between
Yeah.
personal.
Yeah,
Right.
and
And
with
business.
home phones, I take $20 a month off, and then but some people have two lines or different.
Right, so
You
if
know.
you have two lines, then there's a possibility that you can deduct a bit more. But just be aware that you need to think about, I've got to allocate something towards personal and business.
Right.
So we just talked about listed property, and so theoretically, computers fall under the question of is this listed property? And generally, in terms of computers, the question is it really necessary? And this question often comes up for example, teachers. You have a computer at your job, but you find it more convenient to work on your computer at home. The IRS says, no, we don't really find that a very compelling case. On the other hand, if you're production personnel and the computer is absolutely necessary to what you do, your employer doesn't want to provide it, they're willing to pay you a fee for the usage of yours, that's a different story. So is it necessary? For auto expenses, there are two different methods that you can deduct auto expenses under. One is the standard mileage rate, which for 2015 is 57.5 cents. It's actually dropping in 2016 because of the drop in gas prices. That has happened a few times in the last couple of years. So you calculate the total business miles that you've driven, and then you say, I drove 1,000 miles at 57.575 per mile, then I get a $575 deduction. The actual expense method says, all right, let me track the business usage of the car. So if I drive 1,000 miles that are business miles, but I drive 5,000 miles in total, then 20% of my expenses are deductible. Then I tally up all of my individual expenses, gas, repairs, maintenance, insurance, and depreciation on the car, a percentage of the original cost of the car. So I take then the business percentage of all of those expenses. And again, the IRS does kind of look at that and want some sort of compelling record to say, how did you estimate your usage?
I just want to throw in two things. It's
Sure.
usually more advantageous to take the expense rate, especially if you have a newer car. But not always. It's a lot easier to do the mileage rate for the person doesn't want to be bothered. But I also wanted to say that you're supposed to keep a log in your car of when you drive for business. But I have actually had an IRS auditor have my client print out a MapQuest or a Google Maps from one point to the other, and she accepted that as the number of miles.
If you can reasonably kind of come up with a method to say I drove 10 times to this particular spot, and the round trip mileage on that is X.
Yeah.
I find that they're willing to accept that.
Yeah.
Some reasonable. Most of the time they are very reasonable.
So at least if you have, like, I went from point A to point B in my own car, this was the amount of mileage, it'll be okay.
Yeah, it should be.
Got it.
Yeah.
Yeah.
And back.
And back.
And
right.
back.
I
Don't
mean,
forget the round trip.
Yes.
Yeah. Education, for education expenses, the basic cost of qualifying for your profession is non-deductible. It's considered a capital investment in your life, if you will. But once you obtain your basic qualification, amounts paid to improve or enhance your existing skills are deductible. So, for example, I say my cost of becoming an accountant, 4 years of undergraduate college is non-deductible. Once I graduated from college and got a job in the profession, any additional education beyond that, a master's in taxation, was fully deductible. So it's just the basic cost of getting into the field is non-deductible.
Got it. So let's say I'm a working sound mixer, I got a degree, or I started working in the field. If I wanted to go back to school and take a class in who knows what, that additional class would be deductible, but anything I did to get into it, no.
Exactly. That's a good summary.
Perfect. Okay. Just want to make sure I'm clear.
You're good. Yeah. So home office. The question is when is it appropriate for me to deduct a home office? It's almost never appropriate to deduct a home office if you're a W-2 employee. In some cases it can be. You know, I've had some people where they work for a company based out of LA that doesn't have any physical location in New York. So they'll pay my client a monthly stipend to cover her rent. But I'll say that 9 times out of 10, you're likely to trigger an audit if if most of your income comes from a W-2 and you have, you're claiming a home office deduction. So just be prepared. If you believe you can do it, make sure you have the documentation in place before you do it.
Get a letter from the employer saying that it's being provided for their benefit, not your benefit.
Exactly. So for a self-employed individual, a couple of points. One point is make sure you're deducting the home office deduction. If you truly are entitled to a home office deduction and qualify for that, make sure you're deducting it in the appropriate place. There's a specific form called Home Office Deduction Form 8829. And I had a client once who was audited. She actually had produced a loss. The rules for a home office deduction say, we'll allow you, in most cases, if you're paying rent, we'll allow you to completely offset your income up to that, but we won't let you generate a loss. If you own your home, there's a slightly different circumstance. They say you can deduct mortgage interest and real estate taxes, the allocable portion there, and that can trigger a loss because you could have deducted it anyway. Normally you're not allowed to go into a loss. So I had a client that had a space outside of her home where she actually went and paid rent at that space. So when we were audited, she was called in, we prepared a lot of documentation. The only question that they asked was, do you rent in an outside spot? And I said, well, yeah, we have a lease and I can show you checks, and the audit was over. I was like, wait a minute, I've got more documentation to show you. The question, and I said, well, why was that a trigger? And he said, often people deduct it in the wrong place, they trigger a loss, and we want to prevent that. So if you're deducting it, make sure you can. So the question is who can deduct it? There's a couple of standards. One is you have to have a space that's exclusively devoted to your office. So in other words, you have to have a carved out dedicated space, a desk, something. There's what I call the kitchen table rule is don't eat dinner off of it and then clear it and put your stuff down to work there. The IRS doesn't consider that an exclusive space. The second part of the standard is that you either see customers or your clients there, or you do a significant amount of administrative work there. Mm-hmm. So if, for example, most of your work is you're a sound man, you're going out on jobs, you're always in different locations, but you need to do your back office invoicing and so on from home, then that would qualify in that case. For local transportation costs, the basic cost of going to and from work is if you're an employee, is not deductible. On the other hand, if you're self-employed, your home is considered your place of business, so any transportation is deductible. One exception to the rule on employee travel is that if you're transporting gear to a location, and so you have to hire an Uber car to take you there, then that would be deductible. Or if you work really late at night and you need to go home in a cab because it's just not safe, that would be deductible. So between locations or transportation late at night.
And the thing about those, especially the transportation late at night, is that your employer would not reimburse you.
Yes.
Because if they would and you don't ask for it, you can't deduct it.
Got it.
And
of course-
transporting gear could also be in your own personal car.
Right.
Yeah.
Yep. In that case, you'd be doing the mileage and
Right.
Yeah.
Right.
So I'm often asked, when is dry cleaning deductible? And the answer comes up related to the next slide, is expenses that are deductible. Certain expenses become deductible when you're temporarily away from home on business that is otherwise non-deductible. When you travel and your stay is considered indefinite, meaning that, it's considered temporary, which means less than a year. By definition, at the onset of it, is if you expect to be there less than a year, then your travel is considered temporary and all of your expenses are deductible. Once that you know that it's going beyond a year, it flips from temporary to indefinite, and your tax home is considered changed, and those expenses are no longer deductible. We had a friend that shot a pilot in LA, and before the pilot was picked up, and it was not clear that the show was going to be an annual event, then all of her expenses were deductible. The minute that they picked it up and said, you've been renewed for a second season, she bought a house in California because her cost, it became much more reasonable for her to control her costs that way. So while you're temporarily away from home, then things that meals, lodging, transportation, the cost of transporting baggage, auto expenses. I used to have a coworker that we traveled a lot, and so we would set out on Monday and come back from being away for a week on Friday, and every Monday she would bring all of her dry cleaning and do it at the hotel, and then take it home on Friday. And the rest of us just took it to the dry cleaner over the weekend and had our clothes done. So she got to deduct hers and we didn't. So certain expenses then, it's buy your supplies while you're on the road.
Interesting.
And just while we're talking about dry cleaning, I just want to throw in that if you if you wear tuxedos or gowns for award shows that are related to your business, they're deductible, and so is the dry cleaning. But not much else.
Yeah, very little.
Yeah.
Very little. So the
So my shoes.
Well,
now that's an interesting question. If you buy them for safety reasons, that if you have steel-toed boots because if you drop equipment on your foot and you could break a toe and it's sort of recommended, then perhaps you could deduct that. If on the other hand you just like the look of steel-toed boots, not so much. Yeah.
But for instance, perhaps rain gear if you're going to be shooting outside, or snow gear if you're going to be shooting outside in the snow.
That's right.
That could be something that would be deductible.
location gear, padded pants, hard hats, or things like that. But not things you would ordinarily wear in the street.
Right, hot gloves, that kind of thing.
Yes. So keep the receipts for those.
Yes.
So the next slide just talks a little bit about accountable versus non-accountable plans, and it has to do with the way your employer reimburses you. So for most people, when I worked at an accounting firm where I traveled a lot, we would submit an expense sheet at the end of the week and list all of our expenses and then get reimbursed for it. And that was considered an accountable plan because we provided receipts or said, we were entitled to a meal per diem because we were out of town overnight. And so our employer would just cut us a check and that would be that. Since we provided them all the receipts or the documentation, nothing else had to be done. I didn't get a 1099 for it at all. So it just that was the end of it. If, on the other hand, your employer pays you a flat sum, so I pay you $100 a month to cover your cell phone bill and your computer usage, then that's considered a non-accountable plan, and your employer is either supposed to include that in your W-2 or they're supposed to 1099 you on that, and then you deduct your related expenses against that. Some other common deductions, gifts, just know that gifts are limited to $25 per donee, meaning the person that you give the gift to. The way that I kind of look at this is that often I give, if I give a gift to a client, how many people are in that office? Maybe at my biggest client, he's got himself and 4 staff people that I regularly see. So, you know, those people, maybe a gift of $125 if I'm giving to all of the people in the office. For cable TV, it's just like cell phone, you know, make sure you're allocating some usage to personal and some to business.
I want two things I want to say. One thing is that the gift amount has not gone up in years. It's ridiculous.
Right.
And as far as cable television, I've had one auditor tell me that a director was allowed 80% of his cable. And a California accountant told a New York auditor for another director client of mine, 15%.
Huh.
And I told him, if you only accept 15%, I'm appealing. But he ended up giving us a lot of other stuff, so I was just, I didn't appeal. But
yeah,
it's, you know, it's arbitrary.
It is arbitrary, and again, a lot of it comes back to make sure that you show that you've allocated something to personal usage to say that you've thought about it. Even if they bicker with you a little bit on the amount, you know, it'll go a long way to say, I have thought about this. Research, Netflix, movies, conferences and meetings. We spoke about clothing and gym. I like to say never. I get that question so many times. I mean, really the only time that I've deducted gym is where it's prescribed as physical therapy, you know, for medical reasons. Otherwise, no, it's just not worth it. Now going on to just general comments. Another exception to sort of the cash basis rule is related to retirement plans. The IRS allows you to fund your retirement plan up until the due date of your return, including for certain types of retirement plans, including extensions. So you can still get a deduction in 2015 if you fund your retirement plan now. So
doesn't the retirement plan have to have been established in 2015?
It depends. Well, say for example a 401k, that's true, but a SEP plan can be open now.
Okay.
So a traditional or a Roth IRA has to be funded by April 15th. If you miss that date, it's too bad. It's a use it or lose it kind of thing. But SEPs can be funded up to, simplified employee pensions can be funded up to extension date of the return. So, you know, a lot of times clients will say, all right, I'm going to put money into my retirement plan. Here's how much I think that I'm going to do. So file an extension, pay my taxes, and then let's extend the return, and I'll fund the retirement plan after April 15th. So that's a good strategy, and it gives you a double benefit because if you put money into a retirement plan, it lowers not only this year's taxes but next year's estimates. So that helps a lot. A couple of recent tax law changes that I wanted to talk about. There was a big tax act that was passed in late December, and I've forgotten the acronym, but it's PATH, meaning it has something about taxes. But so a few things that are important to people in the entertainment industry. They have increased the tangible personal property expensing threshold. Now, what does that mean? It's most of the time when you buy things like, let's say, for example, you buy a drive. If you buy a terabyte drive, it could cost you, it certainly costs you more than $500. It could cost you $600, $700, whatever it is. I have clients that buy drives, just consume them by the dozens. So technically, they were supposed to capitalize these and depreciate them. The government says, okay, we recognize that $500 is a little bit low as a threshold. So if you're buying things and you elect, there's a certain election you're supposed to make, but things like drives or computer peripherals or something like that, you can expense them now instead of depreciating them. And that's important because if you have a year where you're sort of close to a break-even point, normally the Section 179 deduction, the expensing election, you can't generate a loss. If it would generate a loss, you have to sort of wait and take it in a future year. But by expensing it under the tangible personal property rules, it could still potentially throw you into a loss and be deductible. They finally made permanent the Section 179 deduction, which is the equipment expensing election, which says that I can deduct up to $500,000 of property additions in 1 year. And that's kind of considered the small business expensing election. Most of my clients don't buy $500,000 in a single year, but theoretically the limit was supposed to drop back down to $25,000 this year. And I do have a lot of clients that easily spend $25,000 a year on equipment. So they find, as part of the Tax Act in December, they made this provision permanent. So we all breathed a sigh of relief on that. Bonus depreciation was extended. Now bonus depreciation is, it allows you to take half the cost of the equipment now and then depreciate the remaining cost over a period of time. And it does allow you, for example, if you are in a loss or in kind of a marginal position, the bonus depreciation would allow you to generate a bigger loss. So it's very helpful for some people. And finally, the Section 181, the film cost expensing election, has been reintroduced for 2 more years. They've been, every year it's sort of been, biting our nails to see, has it been approved retroactively to the beginning of the year? But at least this year they said we're going to introduce it for 15 and 16 for sure, and we'll revisit it after that. And the interesting thing was they extended it to Broadway productions. It's not just for filmmakers anymore.
So what does that expense do? Like, what do I need to do to qualify for that?
So the expensing election says, okay, if the original cost of your film is less than $15 million, and most of the productions that I work on are less than $15 million, then you can make an election and say, I choose to deduct all of the costs in the year that I incur them, rather than capitalizing them and deducting when I actually sell the film.
Got it.
So it can give people who are investors a potential leg up by giving them the ability to deduct the expenses from the film this year, as opposed to waiting until the film is actually sold. There are certain limitations on it, however, that you have to sort of. It's considered subject to passive activity loss rules, so that can be a limitation on your ability to deduct it. So if normally the expensing election is made at the production level. So, for example, I have a lot of clients that have film partnerships, and the film partnership has usually a couple of members, the director, the producer, people that are active, and then it has investors. All of those people are getting K-1s, and how much is being allocated to each of them depends on what the operating agreement of the LLC says. But so the question becomes, all right, so I make this election. I would make it at the LLC level. There's a second qualification to it, which is not only is it less than $15 million, but 75% of the costs have to be incurred in the United States. So if you're filming overseas, then you may not qualify for this. If you're actively involved in the production, it's clear that, and you funded the money out of your own pocket, it's clear that you could take that loss. Now, on the other hand, you are an investor, you fund the money, maybe you're not actively involved in the production, then it becomes a question of, can I take this deduction or not? I think a lot of people end up being in the business of making film investments, and that they therefore take, the deductions kind of offset the gains and losses of all the various films. So it's kind of an interesting production, because I've had attorneys argue with me like, no, I don't think the passive activity loss rules apply. and then I produce something that says, yes, I think they do. So
I have two questions about that. Doesn't the year that you take the first year you take the deduction has to be the year that principal photography has begun?
you make the election in the year that the principal photography begins, yes.
Okay, and then if you go into a subsequent year and you have a lot of expenses, for post-production, you could still deduct them that way.
Absolutely.
Yeah.
It's once you've made the election, that's the way in which you're going to continue to deduct the expenses. So, it's the investors just have to be prepared to be sort of whipsawed, if you will, meaning that I get all the deductions now, but the second I get some money coming out of it, it's income
Right.
and tax to me at that point.
Mm-hmm. Mm-hmm.
So, as long as they have the understanding of how the taxation is going to work, then, most people will make the election if they're eligible for it.
'Cause most films don't sell.
Right.
Yeah.
I mean, that's
I've had some good luck with films that have been selling, so that's good news.
That's good.
So just a couple of comments on preparing 2015 taxes. Before you give your records to someone like me or Ann, make sure that you go through the list of all of the 1099s and the W-2s and make sure you have them all. Nothing generates a problem because the IRS has gotten extremely good at being able to make sure that that you've reported all of your income through the matching system of the 1099s. They'll compare the total of the 1099s to your return and say, does it look like they're all there or not? And if not, it'll generate an automatic notice.
How can you tell that? I mean, do you have to go through your records and say, I worked for all these people and make sure you got 1099s?
It's a good idea. Yeah, it's a good idea to have a system to say, I'm expecting 1099s, particularly if you've moved, because often people won't update your address or they don't know to update your address and you just don't get a 1099. If you don't have some system for saying, do I have them all, and you don't tell your person, your tax preparer that, that I had income from this source, the IRS considers it your problem and they'll often charge a penalty for your underreporting.
Right.
Depends on the amount.
Right, and I want to say two things about that. One is that if you are an employer and you pay somebody $600 or more, you're required to send them a 1099. But people who receive money and receive, I don't care if you receive $4, you still have to report it. I didn't get a 1099 for that. I don't have to report it. Yes, you do.
Absolutely.
Okay.
That's yes. It's your responsibility to track the information. And I will say that I've had audits where I had to go through and to prove every single deposit that went through my client's account. Occasionally, they will do those types of audits where they, if there's sometimes they do it for statistical purposes. They want to just sort of see, okay, if we go through an average person's a Schedule C filer, go through their account, see what deposits are there, what's the probability that they've underreported something? So that helps them design audit techniques. But I had actually 2 of those where I had to prove deposits a few years back. So if you have unreported income, then you're likely to be penalized for not reporting it.
Right. And if your mother gives you $10,000, make sure that you note on the deposit who it's from, and in some cases they might even ask for a letter.
I've had that happen.
From the
yeah.
parents saying,
Absolutely.
or whoever gave you the money.
Absolutely. So if you received a gift, keep a photocopy of the check and know that gift is written on the bottom of it.
Right.
For 1099s, make sure you reconcile the 1099 to your records to see what you're being 1099'd on. Because technically an employer is supposed to issue you a 1099 on your services plus any expenses that they reimburse you for. So if you're being 1099'd on reimbursed expenses, you want to make sure you're deducting those expenses.
Right.
I had a client the other day who said, I do her partnership return, I don't do the personal return, but she was like, oh, I never knew that. I never gave my accountant those expenses. So, if they're material, it can be a big deduction.
Sure.
Double check when you're giving your accountant, double check your estimates and be sure to write them down and give your accountant the date and the amount that was paid. I've had any number of clients that thought that the January payment was related to this year, when I'm saying, no, it's related to the fourth quarter of the previous year.
Right.
So we get a notice and we're scratching our heads trying to figure out why the numbers are wrong, and it's because they gave us the wrong totals.
Right.
So I try to ask for copies of the checks now, just to make it a lot simpler.
That's if you're writing checks.
That's right. Yeah, yeah.
Some
It's even
people are-
better. It's even better if you go online. It's a lot faster.
Yeah.
Health insurance. It's typically deductible. If you're a self-employed person, it's typically deductible on the front of the return, so long as you're showing a Schedule C profit. As an employee, if your employer is, if you're paying in, so it's only potentially deductible if you're not using pre-tax dollars. If your employer has one of those plans where you can put away money tax-free towards your medical expense, you don't get a deduction. But the problem is let's say you're paying health insurance premiums, you have to meet a 10% threshold to be able to deduct that. So going back to the example of you're making $100,000, and yeah, so you can start deducting medical expenses when you have more than $10,000 of expenses. And it just is a lot harder for people to reach that threshold.
Right. Okay, welcome back after our short weather delay. We're ready to continue on for the rest of our game. Take it away, Nancy.
Great. So we're almost at the end. We were talking a little bit about health insurance, where it's deductible, what kind of thresholds you have to meet. The penalty has gone up for for failure to carry the coverage. I think it's $325 is the maximum penalty per person. Be sure to be on the lookout for forms 1095A if you obtained your coverage through the marketplace, through the health insurance exchange. If you obtained an individual policy but not on the exchange, you should be getting a 1095B. Some employers are providing 1095Cs, which are through large employers, but it's not mandated yet, so you may or may not get it. But we as preparers need to know whether you had coverage for all 12 months. And finally, I just wanted to talk a little bit about considerations for 2016. The most important thing that I find is that it's really important to make sure that you are setting aside enough money as you go to pay your estimates if you have self-employment income. And depending on how much you're making, 25 to 33% on the dollar is kind of the appropriate amount to set aside. Because I find for a lot of people, you get behind on your taxes and then you're suddenly behind the 8 ball, you're using the money you're currently making to pay off last year's taxes, and then in April next year we'll have the same issue. Right. So it's the best thing is bite the bullet, get on an installment plan, and then start setting aside the money as you go to pay. Fund retirement plans as you go wherever possible. So the double whammy or triple whammy is April 15th, you have to pay any balance due that you have for the 2015 return. You also need to pay your 2016 first quarter estimated payment. And if you have to make a retirement plan payment on top of that, you're probably not going to fund that retirement plan. So pay in as you go and it'll help. If you're considering incorporating or forming an LLC, it's best to consult a professional to understand all the implications, because the implications for having a corporation are very different than the implications for having an LLC. And then just make sure that you have a good system in place to track your income and expenses. Because if you contact me during the year to talk about how much should I be paying towards estimate, I need to have a sense of how much income do you have and how many deductions do you have to tell you something other than the general rule of thumb. Mm-hmm. Is there anything you wanted to add to that?
Well, I was going to say to remember that if you live in New York City, not only are you paying federal tax on your net profit, but you're also paying state and city tax, and you're paying
unincorporated business.
No. I mean state and city income tax,
right.
And also you're paying your own Social Security, which is 15.3% roughly of your net profit. So
right.
I always tell people to put aside 40%, but that's
Yeah, and that's what I do personally as well, because I've gotten
great.
whacked.
Yeah, that's great.
As you say, and then you're behind and it's a whole thing.
Right.
So it seems like the lesson of the day is this is not just tax time now, it's tax time all the time.
Right.
So you can be ready for now.
Sure.
Exactly.
And I get calls all year long. It's not, this is not a seasonal business. I mean, there's a crunch time, but, I'm answering IRS letters and questions and doing profit and losses for people, and so it goes on all year.
Yeah. So just a quick question, it may not be quick, but If I was somebody who was just getting into the business or starting to become successful at the business, where does it make sense for me to to incorporate or form an LLC, or is there kind of a general rule of thumb for that?
I'll let you feel this one, Ann.
Well, all right, let me just say that my advice to anyone who is salaried, and I get this so many times from people in the field business, shouldn't I form my own corporation to become a loan out? Absolutely not. In the first place, you have to do a new set of taxes. The second thing is that you cannot collect unemployment insurance if you have your own corporation. And if you work sporadically, that's a big deal. And there was a third thing, I forgot what it was, but I basically tell people, oh yes, the third thing is that you're letting the employers get away with murder because they're not paying half your Social Security or your disability or your workers' compensation, and you have to pay it for yourself, and in addition, you have to pay the unemployment insurance that you cannot collect. So that's my...
That does add a bit of insult to injury.
Right.
Financially, I mean, where do the numbers tip? I mean, I would say that probably if you have a steady business where that your work is not quite sporadic, you expect that you'll be working year round. I mean, maybe 100 to 150,000 kind of makes sense. That when you sit down and put the pencil to paper and work on numbers, you start to end up paying a little bit less in taxes if you choose, for example, an S corporation. So it really does depend. It's like the beginning of the presentation. It's a facts and circumstances thing.
Right.
So it depends a lot on your personal preference and what you're comfortable doing. I have some people that they want to be a corporation because they can't set aside money to pay self-employment, to pay the estimated taxes. So they want a W-2 where they're getting a regular paycheck and their withholdings. But Ann has some really valid points to say that if you need to collect unemployment, you won't be eligible for it. They only let you do that when you dissolve the corporation. So you have to go through a lot of hoops to do it.
And the other thing is that people are under the erroneous assumption that if you have a corporation, you can deduct more of your car, for instance. But the fact of the matter is that you can only deduct what you're allowed to deduct, regardless of whether you're, a sole proprietor or a partnership or a corporation. So, I mean, I've had, car people say, oh, they told me if I lease the car, I could deduct 100%. Not so if it's not 100% for business.
I agree with that.
Yeah.
Yes, yes.
And so if you're with equipment, does that change anything? Like if I'm somebody that rents out sound equipment and provides my services, so I'm getting X number of dollars for my personal labor and X number of dollars for equipment. Does
That's
that
an interesting
change
question, and it's. I had somebody contact me because I'd made a comment last year in this presentation. My comment is that it depends in part on whether you're in the business of leasing equipment.
Mm-hmm.
Gotham Sound is in the business of leasing
Yes.
equipment. You're not necessarily in the business of leasing equipment. You might, on some jobs, you might work on equipment they provide.
Mm-hmm.
On other jobs, you might provide your own equipment. There is a case to be made that your equipment rental is incidental to the service that you're providing. In that case, you get a 1099. They report the equipment rental on in box 1 of the 1099. You report that on Schedule E, and you deduct depreciation expenses on the specific equipment there. Mm-hmm. Why does that save you? Well, it saves you self-employment taxes on that.
Right.
On the other hand, if it is integral to your business and it's a package deal where you always rent your equipment and you always provide the service, then it is integral to your business. So it's that's certainly something you should talk with your tax professional about.
Yeah. Well, I always tell my clients if it's if it's incidental that they should bill separately, but there are still some employers who want to lump it all into non-employee compensation because it's easier for them. So then you have to keep records.
Make sure that you separate it out on your invoice to say
Right.
equipment rental
Right.
and service.
Right.
And then when you get check your 1099s. This goes back to checking your 1099s to say,
Sounds awful.
are you getting, are they showing an amount in box 1 and a separate amount in box 7? So,
And so when do you ever have anybody that keeps their own set of books, like just as a personal entity, and they're like, here are my books, and
yes, I actually
have a
do.
reconciled bank account.
I have a number of people that will keep their sort of books in QuickBooks Online or something like that because they find it very simple to use. But other people provide their information. They track it in Excel, for example. We accountants type, we sort of like it when you use a software package. The joke is old accountants never die, they just become unbalanced. The issue is when you provide it to me in Excel, I mean, I have no way to sort of say, oh, look, she's reconciled her bank account and the totals, so I know that all the expenses are in there and that it's all been accounted for. If you just provide an Excel spreadsheet, it's hard for me to check and make sure there's sort of accounting integrity there.
And do you know of any places where somebody who has no idea, because a lot of the we're technicians, we're not necessarily numbers people, or we're artists, we're not necessarily numbers people. Is there a place that one can go to get a bookkeeping background? Is that something that would be useful or that you recommend to your clients?
I have to say that QuickBooks has a ton of videos online. They have their own little YouTube channel where you can, if you say buy the most basic package of QuickBooks Online, you can use it and you can watch their videos that's going to give you a little bit of training on here's how you do it. And it's non-accountant types say, I find QuickBooks Online so much easier, where us accountant types are like, I find it confusing. It's different than the old system.
Right.
But there are a lot of resources out there for basic deductions and questions that if you Google it, I think that you can find a lot of information on it.
Got it. Great. As long as I don't have to fill out those tax forms. All right. And Ann, Nancy, anything else you think we should know? Any other tips and tricks or pitfalls that you see?
Get your information in early.
Yes.
Because if you get it in too late, it's more likely to have errors or problems. It just is. The sooner you get it, the more time we have to kind of look at it and ask you questions like, oh, did you think about? But after April 1st, it's a mad scramble.
Right. And the other thing is that people are also under the erroneous assumption that they can file an extension for the payment of their taxes. Not so. The extension is only for the paperwork. You're required to pay your taxes, and you're required to pay your taxes by April 15th, but if you're self-employed and you would owe, I think it's more than $1,000 at the end of the year, or with New York State, I think it's $300, I'm not sure, you're supposed to pay estimated taxes quarterly, and you can incur penalties and interest if you don't.
That's right.
Or the other thing is you have to pay at least as much as your tax liability was for the prior year, unless your income goes way up, and then you're supposed to increase your estimated tax payments.
Right, and that's definitely a common thing for people who are 1099 or just start being 1099.
Right.
Is all of a sudden they get more than $1,000.
Right.
Yep. The best way to describe it is we're a pay-as-you-go system.
Right.
The simplest way is if you're a W-2 employee, then your employer takes out the taxes and withholds for you, so you've paid. But if you're self-employed, you need to figure it out and get a system for when do I have to pay it, how do I pay it, where do I pay it.
Right.
So consult a professional for that.
And you had asked a question about putting down the number of exemptions on what is known in the film business as your start paperwork or W-4. And I have a couple of things to say about that, and you could probably add. One of the things is that if you live in New York and you work out of state, do not play around with your deductions. You put down whatever you are entitled to. If you're entitled to 1, you put down 1. Because if you don't have enough of that state taxes, because you're taxed in the state where you work, and if you don't have enough taxes withheld for that state, you will end up owing that state. But coming back to working in New York, let's say you could play around with your deductions. If you, let's say you get a job where you make $10,000 in 1 week and then you don't work for the rest of the year, you could put as many as 9. I think it used to be you could put, people would put 99, but then the IRS said no, if you put 9, the employer has to explain why, and I'm not sure whether that's still in effect. But the point is you could put more exemptions so they would take out less money because you don't want to wait to the end of the year to file your taxes to get it back because you need it, when you get it. But you've got to be very careful about that. And if you're married and you have 2 incomes that are the same and you're taxed at one bracket, and you file jointly, which is usually more advantageous than filing separately, and you combine those incomes and jump into a new bracket, you're taxed, the entire income is taxed at the higher bracket. So these are all things to consider.
Yeah, and oddly enough, the married filing joint ends up taking out, when you claim married on your W-4 form, it ends up taking a little bit less withholdings, where if you're both married, both working, you could in fact be pushed into a higher bracket. So you really do have to kind of be careful with that.
And there's a box you can check off that says married but withholding at the higher single rate. I mean, you could also check off single, but people say, oh, I can't do that, I'm married, so they added that little box. So.
Right, you don't want whoever's reading it to get the wrong idea.
Well,
yeah, of course. And I guess the other question that came up while we're in our rain delay is, what if I'm working in Europe or in some other country? And they're paying me in, in euros or whatever. Is that something I need to declare, or do I just put that in my pocket?
And you also better keep the conversion rate while it's happening too.
Yes.
Actually, the Treasury issues conversion rates at the end of the year. There is a Treasury conversion rate that we use for a lot of stuff. We have a number of clients that have foreign bank accounts, so there's a special reporting that you have to do with that. So we use the Treasury conversion rates for that. The general rule on services is you're taxable in the place that the services are performed. So if you're performing, if you're doing work overseas, then technically they're supposed to be withholding taxes on your income over there. They're really good about that when you're an actor. I've had a number of clients that actors that have worked in Canada and worked in different places in Europe, and they took a flat withholding tax and then paid them the net. And then once my client got back, you're taxable in the U.S. on your worldwide income, but you get to take tax credits for taxes that you pay to foreign locations. Now, the interesting thing about that, and it comes back also to city taxes, is if you work in California, for example, and then you come back and you pay tax on that same income in New York, the taxes that you pay in California are there. They can offset your New York State tax, but they don't offset your New York City tax. So you might owe another 3% on top of that.
Now, let me just say that Entertainment Partners understands how to do it, because if you're working in any state where, well, first of all, if you're working in a state where the tax rate is lower than it is in New York, they're supposed to be taking that state's taxes out, and then in addition taking the difference out for New York State, and also taking out your New York City tax and paying it. And it's very important for people if they do that to look at their check stubs and see if the taxes are being taken out. And as I said, Entertainment Partners, I don't know about the rest of the payroll services, but I know Entertainment Partners gets it and is usually correct. But some of them don't, and then you end up owing.
Yeah, you do have to be careful. I was recently on a production where we're working with another company where, it's the editor's agent was located in California, and she was using a California mailing address, and I wrote in the email 4 times, like, make sure you're taking out New York withholding. Make sure you're taking out New York withholding. The first paycheck she gets, she's like, why are they taking out California withholdings? I'm like, so, yeah. So anyway, it's you should look at your pay stub and make sure they're taking out the right thing. And if they're not, contact your paymaster or the production accountant and say, this doesn't look right.
Got it.
Right.
Cool.
Right.
Okay. All right. Well, Nancy, Ann, thank you so much for being here. Is there anything else that you wanted to add?
No, not that I can think of. Call your accountant early and often.
Yes.
Right. Preventative maintenance.
Yes.
That's right.
Perfect.
Absolutely.
All right. Well, thank you again so
Thank
much
you.
for
Thanks
being here.
so much for having us.
Yes.
Yes.
Thank you
Really
very much for doing
interesting.
this.
Mind-breaking stuff. All right, so, and thank you for watching today. Next time, next Tuesday, February 23rd, we're going to have a vehicle miking demo with Giovanni Lima Jr., who is the sound mixer from Comedians in Cars Getting Coffee. You can watch this video and more at vimeo.com/GothamSound. You can find us on Facebook, Twitter, and if you have any ideas of things that you want to see, if you want Nancy and Brenda to come back next week or the week after that, email us at info@gothamsound.com.